Are you taking questions right now?
Yeah, I'll
Yeah.
take a few quick questions now. That's fine.
Okay. I'll have one. Before I give you the question, I really appreciate some of the threads that I've seen that you were saying, don't just follow me blindly like that. And I appreciate you saying that. And the takeaway for all of this is just for everybody to learn. And I really like what you said in there. Appreciate that.
Good
So
job.
here's the thing. When I was looking at the spreadsheets, considering that I'm a newbie here, I'm looking at some of the parameters that you've included. Like I see margin, I see premium, there are numbers, but I don't know where they're coming from. It would really help if you can at least maybe show us where that's coming from, or put a notation. How did you get those numbers so that we can follow? And then that way we'd be able to start learning by ourselves and not just following you blindly.
Sure. Yeah, that's a good point. Let me share my screen. I'll answer that. So all the margin numbers I'm getting are off Tasty Trade. Depends on the brokerage you're using. They might have slightly different margin requirements. And also it depends on if you have portfolio margin. Those are for very large accounts, like over 100 grand. If you're using span margin, there's a lot of different things here. So I'm just writing what I see on my brokerage. Okay. For instance, let's say I had Apple and I tried to buy 100 shares. So Apple 100 shares. Here it says estimated buying power effect, 12,430. And on Tasty Trade for most positions, it's 50% of the total price if you bought it without margin. So if you bought 100 shares, it'd be 24,583. Essentially divide that by two, and you're getting this $12,000 number. And that's pretty typical for most stocks on Tasty Trade at least. And other brokers is usually around that. When you're selling puts, though, it could depend a little bit more on the brokerage. So for instance, let's say I sold a 29-day 240. The buying power effect here is 43.57. So I'm just writing down the numbers I see there. Okay. Does that make sense, Ron?
Yeah. It's just that your platform is really different from the platforms that I'm using. So I still have to
Yeah.
familiarize myself with those. So one
Yeah,
more question, if you don't mind.
there's definitely a learning curve in the different brokerages and like where things are. In general, when you're entering positions though, like if you're selling an option, usually you click the bid price and that usually makes it a default of like selling it. I remember I talked to you about that earlier. And that's like that in almost every brokerage, like Thinkorswim, Robinhood, Tasty Trade,
Mm,
one. All right,
yeah.
what was your other question?
Yeah. When you're trying to pick for the calls and the puts, do you have like a rule of thumb for the deltas for the call and the put?
It's hard to say a very specific rule of thumb. I would say the default is trying to sell the call at around the point 0.3 or so delta is where I usually start looking, but that doesn't necessarily mean I'm going to do it there. I want to look at the technical analysis on the stock and see is it bullish, is it neutral or bearish, just based on what might be happening, like with the trend of the stock. So if the stock, if I think it's overbought, let's say it's near the top of the Bollinger Band or the RSI is like 80 or it's way above a moving average, there's a decent chance it might start to bounce down. At that point, I would probably sell a little bit of a higher delta just because I'd taken more premium in that case. So for instance, let's just look at Apple again while we're here. I haven't seen too much in the stock, but when you look at it right now, we're near a recent high.
On the sun, and the sun was allowed to scorch people with
Check your mic
fire,
real quick, please.
and they were seared by the intense heat, and they
Someone's audio is
cursed
on
the
there.
name of God.
Thanks. So if you're at like a recent high here and we're near the top of the Bollinger Band, try to zoom in more. So I would probably sell close to a point 0.3, maybe a point 0.35 delta or so. If we were near the lower end,
What?
I might sell a little bit of a lower
What?
delta possibly just to take in more
I
possible
did.
on the capital gains. Like if we were in the bottom of the Bollinger Band right now, there might be a good chance it recovers back up. And then at that point, I would want to probably sell a lower delta, but that's not a hard and set rule necessarily. Personally, I usually just look at the premium and see is it worth it or not. So I'll pick a cheaper stock like Iron. It's one that we're currently in. 12.26. If I go around 30 days out, it's been pretty bullish in general. So I know recently it moved up a bit. It's starting, these are 1 hour candles, by the way. So in the 1 hour candle, we're a little bit lower. But yeah, we were near a 13 change, which was pretty high considering the last few points. So now we're actually at a little bit in the lower end. I would look at the premiums um out of the money just to see how much I could take in, depending on my margin as well. So
What do you mean by premium? Is it the cost?
no, the premium is the amount of money that you could take in when you sell it, because we're selling the call. For IRN, remember it's about 50%. So 12.36. If I bought 100 shares now, it's a little more just because I have other positions, but it's typically about $700 here. So right now, $800, let's say. If I was gonna sell a call, I could look around 0.24 delta maybe. Take in 35 to 42, maybe around $38. And then you just do the math. You're taking in $38. You're using about $850 for the shares that you own. And then you're getting about 4.5% return off your margin in just the premiums. That also could give some capital gains if it happens to go up to that strike price. Does that all make sense? On the put side, in general, I might usually go a little bit lower delta, but I also want to make sure the premium's worth it. So iron's 12.36. If I sold like a 9 put here, it's not paying much, $8 to $14. The delta's really low there. It's probably not really worth doing in the end. So I'd go a little bit higher, maybe the 10. There's a good chance I sell the 10 tomorrow or Monday. I might make about $22 or so. And then if you do 22 divided by the margin of 298, that's still a good return. 2 divided by 298, we're looking at around 7% on your margin requirement.
So here's a little technical comment. When you talk about the deltas and the put, and you said it's too low, you'd find something higher. I, my interpretation with those with negative, the more you go higher, it's actually lower.
Yeah, but it's the absolute value of the delta.
Okay.
So it's going like negative 0.14. This means
Okay.
that there's about a 14% chance that we would get below that 10 price at expiration. So just
Okay.
don't worry about the negative, just think about it as a positive. The closer you go in the money or closer to the current price, the more premium there is. So if I sold, say, a 12 put, I could take in maybe $90 off it, but there's a better chance that I could get a sign on it because we're closer to the price, right? So every gimme, there's a gotcha. If I go further out of the money, there's a less chance it's going to get down there, but you're making less premium as well. So it's kind of like a seesaw. You got to try to see what is best for your preferences. If you're willing to take a little bit more risk, you want to sell closer to at the money. If you want to be safer, you go further out of the money. That's just in general. Okay.
So when you're looking for stocks to dig in deeper, what are your criterias?
Um, there's quite a bit there. One one is the fundamental analysis of the company. So one place you could easily go to is seekingalpha.com. You can do a free one here. And if you look at, I don't know, just Apple, for instance, I want to see just general trends in the financials. If their income is increasing over time, their earnings, are they buying back shares? Just general fundamental things. Go to financials. All right. So if you look at Apple, for instance, from 2020, it was 274,000, or I think that's million. And then as you go towards 2024, you see how the numbers are increasing every year. And that's a good trend to see because it's getting more revenues. Gross profits increasing, earnings per share increasing, things like that. So I want to look at the general trend on these numbers. If you go from right to left, just because we're starting in 2020, and then you go towards the present, you want to see the numbers be going up in general. Um, there's a little more you can do there, with like PE ratios. The PEG ratio is another one to look at. That's the price to earnings divided by the future outlook of their earnings. So if that's a low number, that's good, just because the current PE is not that high.
Can I hold your thought on that first? Sorry, because I'm still learning. You're just too fast for me right now.
Sorry,
So
yeah.
if you if you take on one criteria at a time, you mentioned about PE ratio. What's a good PE ratio to you? And then you talked about PEG. What's a good PEG?
It,
Something.
it really depends. Certain companies like tech companies usually have higher ones in general, just because the market's expecting their earnings to be growing pretty fast. But if you're looking at, say, a utility company or a REIT or something that's not a big growth type company, the PE ratio will be lower. So another thing you can consider is looking at the PE ratio compared to other ones in the same sectors. So if you're looking at, say, AMD or Nvidia, the PE ratios will be higher. If you look at, say, Realty Income or something, the PE ratio will be lower. And
Sometimes I see PE ratios to be negative. Does that matter?
yeah, that would mean that the earnings went negative. That's usually not a good company that you want to look at in general. Um, if you're looking at very small cap companies, I might have that, but they're, spending a lot of their earnings into growing the company. That's why it might show negative, but then it might eventually trend upward. SoFi is a little like that. SoFi was negative on their financials for quite a bit. And then they started to get positive just recently because they were spending a lot on trying to grow the company. Like if you just look at operating income here, these parentheses were negative, but then just last December it turned positive. So these numbers are looking pretty good in general because it was getting less negative and now we're positive. So that's why I picked SoFi, for instance.
Hmm.
And then as for technical analysis, as you see a lot of times when I'm talking about different things, you want to see is the trend upward. Um, just a long-term trend here. In February last year, we were really low, in the nines, and now we're up to 12. You could look at a lot of stuff. RSI, is it increasing? Is it above the moving averages? Things like that. I'm not going to spend a lot of time on that right now just because it's a pretty detailed question here.
I
Um,
understand. Thank you.
no problem. Any other general questions from anyone else right now before I go into the married puts? You could ask about anything.
Okay.
Hi, Bill.
Were you doing something that was creating a noise?
I didn't hear a noise.
Okay.
Bill, do you have a question? Might have been in the background. Anyone else have any questions so far? Just general questions? All right, go ahead, Michael. I'm sorry, Mark, I think.
Yeah, that's right.
Sorry.
Hey, Lance.
Go ahead, Mark.
Just real quick on this chart that you're looking at for checking the technical analysis.
Yeah.
What is the chart? Is this a 1 hour chart that I see
Yeah,
or am
right
I
now
looking?
this is a 1 hour chart. In general, for technical analysis, you want to look at multiple time frames. So usually you want to look a bit further out if you're going long term. You look at like a monthly chart. Let me do one on, say, Apple. That's a little bit more straightforward. So if you look at the 1 month chart, each candle's a month here. Apple obviously has been doing very well in the last, decade or so. And then you want to narrow it down a bit, maybe the daily chart. Look at the daily chart, it's a little bit more of a consolidation. We're around 218, 250 or so. And you just keep bringing it down. Um, Looking at where you're gonna sell like the expirations on options. If you're gonna sell around a month out, the daily chart is probably the best for that. And it depends on your time frame. If you're selling a, weekly option or a daily option, you'd probably want to go in a much shorter time frame in general. But it's good to see like if you're getting very similar results in like a daily chart. So if you look at Apple in the last week and a half or so, sorry, it's been trending pretty upward. I'm having trouble with my mouse here. Ah. Yeah, so if you see here in the last like week or so, we went from 227 all the way to 246. And this is daily candles. So this is a pretty bullish indication just because it's been going up quite a bit. And it's also above these lines. These are the moving averages. If you go in a shorter time frame, in this example, it's still going to show that just because the daily candles were pretty much all positive. So that means the shorter time frame is going to be very similar in general. And that's another confirmation that it might be more bullish.
Got it. Okay. Thank you.
Yep. Any other questions so far?
Lance, can I ask about the stocks that you've chosen? I see in your message that you said you'll start managing it tomorrow. The list goes like CCL, Iran, Sophie, SOUN,
Yeah.
and two others. So, which of these stocks would be new?
All these I already currently have. So,
Okay.
and this is my positions. The reason why I picked those were they're either really close to the strikes, and I would probably have to manage them today and or sorry, tomorrow instead of Monday. So if you look at say CCL, we were right by the 24 this morning. I actually wrote about it. Right now we're at 24.56. It's pretty close to the 24 strike. So what I don't want to, it's not a big deal, but what I personally don't want to have happen is it goes below 24 tomorrow, and then I get assigned these shares. I'd rather just roll the option out another month. So I'm going to be buying this back, hopefully around where it is now, because I sold it for 47. Hopefully I can buy it back around $7 or $8. And then I'm going to sell another one out a month. And the reason to do that is I'll still be using the margin from selling the put instead of getting a sign and owning another 100 shares. Because if I bought CCL, I need about 50%. I'll need about $1,200 in margin. But by selling the put, it's quite a bit lower. So if you see, I just closed the position here. It's about $400 or so. So it's a little bit more efficient in your buying power by not getting assigned shares. I'm still okay getting assigned shares by doing the strategy though. In general, I'd like to wait it out a little bit. If I could continue to sell premium and get income, ideally you don't get assigned too much on a lot of stuff just because you could be using a lot more margin at that point. That all makes sense?
Thank you, Lance.
Yep. Um, any other quick questions? And then I'll go over married puts and then I'll leave it open for other questions from anybody. All right, let's go over some of the married puts. Have a little bit here prepared. If you're a lot of you guys are new, so this is a little bit beyond what the main strategies of what I'm doing. My main goal is to sell premium by selling calls, selling puts and whatnot. But I'm also looking at ways to protect my positions if it drops. Okay. So you could be selling premium for a while, and then if the stock completely tumbles, you could possibly lose all the gains that you made and even more. So I'm looking for ways to protect my account when that happens. Okay. One way to do that is called a married put. A married put is essentially when you buy shares of stock and then you sell, sorry, you buy an option with it. Back to the Apple example. Apple's around 245. What you could do is you could buy a put, not sell it. You could buy a put at, let's say, the 250 strike price, and it's going to cost you, it's about $1,400 or so, which at first sounds like, oh, I wouldn't want to do that. But if you're bullish on Apple and Apple has that good chart with the daily candles moving up, if it continues to move up, it's also good because you own the shares of stock. However, if it happens to drop by buying this put, you're very well protected for any downturns that will happen. Okay. Um, Might be a little bit advanced for you guys, so feel free to ask questions here. But let's say you bought the 250 put, and I did this really far, about 148 days out. So what is that? 5 months out. What are the possible situations that could happen with the stock? So if the Apple just keeps shooting up and goes up to say 300 or so, in that case, we would have capital gains, 300 minus the 245, about $55 in capital gains. I'll take $5,500, that'll be good. The 250 put though, at expiration would be worth zero. Because when you buy a put, you want it to go lower than where you bought your strike price at. So you'd make about $5,500 in the stock, but you would lose about $1,400 by buying the put. Still pretty good outcome in the end, right? What if the stock completely tumbles and goes down to like $200 a share? If you didn't buy the married put, you would be down from 245 down to 200. You'd be down about $4,500. And that's not good. But what if you bought this put with it? And this might get a little complicated. Try to say it clearly and slowly here. If we went down to 200, this put would be worth the difference of 250 minus 200. This option would be worth 50. Now we bought it for around 14 and so. If you could sell it at 50, you made about $3,500 in gains off just that put. Yes, you would have lost about $4,500 in the shares, but you would have made about $3,500 in the put. Apple could go down as much as it wants, go down to say $2 a share, and it would be capping in your losses because the amount of money that it goes down in the capital losses in the shares would be offset by the put that you bought. All right, does that make some sense? I know it's a little tricky.
Lance, how do you decide which DTE you would choose and which strike price you would go for when buying puts?
I was about to go over that later, but yes, I'll get to that in a few minutes.
Okay, thanks.
Any other just general questions on the math I just said? Okay. Now let's look at a possible more realistic situation. Let's say it stays exactly where it was at 245 or so. In this case, the 250 put would be worth about 5. So if it went from 250 to 245, just subtract that. This option will be worth 5. You bought it for around 14. You would be down about $900 by doing that. So you, for every gimme, there's a gotcha. If you want to buy a put for protection, the stock would have to be going up at least a little bit in general in order for you to profit on it. If it drops a lot, though, you are very well protected for it. So this is more of a protection type strategy. Just buying the put by itself is not an income making strategy. Okay.
Can I clarify what you're doing here? Are you saying that you should buy both 14.15 and 14.30?
No. This is just the option chain. So you would have to buy the put probably closer to the 14.3. You probably will end up getting it for around 14.2, 14.25 or so. This is just
Oh,
the
yeah,
difference.
yeah. Okay,
Yeah, it's not both. You're going to be just getting one price, obviously.
right.
All right. So now, if you wanted to protect your stock, let's say you bought Apple when it was like $100 a share or something, and it went up a ton here. Doing something like this could make a lot of sense just because you're capping your losses. If it drops a lot, the put is worth quite a bit. and you won't be significantly losing a lot of money if you didn't buy this. Okay? So in general, it usually makes sense to buy a married put on positions that you might have held for a while already, or if it ran up a lot and you want to try to lock in any possible gains. You could still do this right away when you open a position. It's going to be a little bit more advanced. I'll probably have to wait to explain why in another one. But in general, if you already had a big gain, it would make some sense. If I look at iron, I'll show you on my spreadsheet here. I initially bought the shares at 11.28, and I was selling covered strangles since November on this. All I did is I subtract my premiums that I collected. My cost basis is 7.39. It's quite a bit lower than where I bought my shares. And it's also, you look at iron right now, we're at 12.36. There's over a $500 gain off the cost basis already. It would make a lot of sense for me, at least, to be buying a married put off it. It may not necessarily make a lot of sense for you if you're just starting out on the position. Okay? Does that make sense so far? Questions? Go ahead, Alan. Alan, any question there?
No, I'm good.
Okay. Now, we need to be able to figure out ways to try to also mitigate the cost of this married put. For iron, I would probably go pretty far out in time. I currently have one at 85 days out, and I bought the 8 put. I bought it at around 90 something dollars. I think it was $95. And the bid ask spread is really wide right now. It's probably only worth about $45 or so. But if it drops really hard, at least I have this protection that could help offset some of the losses if the stock goes down. If you are currently not in the position and you're thinking about doing this, I'd probably go even further out in time. The reason why you want to go pretty far out in time is when you buy a put, you're having to pay theta decay. So the main way that we make money by selling options is we take advantage of the theta decay. Every day that a stock doesn't move, the value of the option would be down a little bit just because theta is making it closer to the expiration date. By buying options in general, you probably want to give yourself more time because the theta is lower when you're really far out in time. That's why 0 DTE, for instance, can move so much because the theta decay is so quick because there's only 1 day left in that option. I would consider around 148 days out. Stock's at 12.36. I like to go a little bit in the money just because there's a little bit more protection there and it's not that much difference in cost. So if I bought, say, a 12 put, it's about $220 or so. If I bought a 13 put, it's not that much more, 200 maybe $70. And you get an extra dollar of protection because you're one strike higher. That's just a simple answer of why I would usually want to go a little bit in the money when I'm buying a put. Does that make sense? Questions on that? Sorry. All right, so if you were going to be buying, let's say the 12 or 13 put, about $270, you also want to be able to offset some of the costs on that. And that's when you just do the typical covered strangles that we've been looking at. So just ignore the married puts for now, and let's look at just a basic covered strangle. 12.36 is the stock. It dropped quite a bit in the last few days, but it did have a good run up before it. I'll go to say the daily chart just because I'm trying to sell around 30 days out. It hit near 13. It had a good uptrend, and then we had a fairly big down day. So I'm gonna probably sell a little bit further out on the money just to get a little bit of decent premium there. This stock in general has pretty high implied volatility. That means that the option premiums are pretty high compared to like lower volatility stocks. 12.36. If you look at, say, the 16, let me go like 30 days out or so. If I look at, say, the 16 strike price, you could take in around $22 or so. But then there's a possible pretty big capital gain there. You could go from 12.36 up to 16. You make almost $400 in capital gains if it happens to go up here. The 15 pays about $40 or so. I'm just looking at the middle numbers of these two. So if I saw the 15 strike, you're capping how much you could make in capital gains because if I sold this, I'm agreeing to sell at 15 instead of, say, 16, but you take in more premium because it's closer to the strike price. Every gimme, there's a gotcha. The further out you go, the lower the premiums, but the more possible capital gains. In general, I like to look for a decent amount of premium and be perfectly happy with selling the shares at a certain price. The 15 is looking pretty likely of what I would be selling tomorrow. Maybe even the 14, because that's paying, $57 or so. Now I'm just doing this all as, 100 shares of stock. Obviously, if you have a bigger account, like it's $57, that doesn't really make much difference. But just imagine you did this with 1,000 shares, then it's $550 or so on. Okay. For the put side, I would probably look at the 10 strike, maybe even the 11 strike. If I was just starting out on the position, the 10 strike probably makes more sense. But my cost basis is lower, or my cost basis is 7.39. I wouldn't mind getting assigned a little bit higher, just in my case. But if you're first starting out, I'd probably just sell the 10 strike. If you sell a 10 put, it's using about $298 in buying power, and you're taking in around $22. So if you do 22 divided by 298, that's 7.3% return off the margin in a month. And that's really good to get. Okay. Questions on that?
Hey, well, answer just real quick.
Yep.
So you had mentioned that iron has more volatility, right? So are you looking at the IV for that, or how are you judging the volatility on that?
I just know that it's very volatile, to be honest. I don't even
Okay,
look it up, but just by doing this a lot, you could tell that somewhere more. I would just type in implied. And you can look at IV rank, IV percent, and all that, but I wouldn't even really worry too much about that right now. Iron implied volatility is 79.1, which is pretty high. Um, just looking at the premiums, honestly, is just an easy way to go. Like if I
gotcha.
did realty income, that's a REIT that doesn't have much volatility. It might be a little higher because earnings are coming up, but 56 is the strike price, is its current price. If I sold at 52.5, it's only taking in like $17. So you can just see it just by doing that. In general, you want to sell when the IV rank is pretty high. That's because the premiums are higher at that point. That's just a general thought, though. Okay.
Gotcha.
So the positions that I'm doing, I purposely do some that are a little bit higher in volatility and some that are lower in volatility, just so you guys have a good range of ones that you can look at and consider based on your risk tolerance as well. DVN, for instance, is a fairly low amount of volatility in it. That means that it's not going to move up and down dramatically. and 38.55 a month out. I sold the 35, took in about $26 or so. Not a ton. You could do the same thing with iron with like a 10 strike and take in the same amount. So that means the volatility is higher, right? The stocks that have lowish implied volatility, DVN, CCL is pretty low. Silver is pretty low. I would recommend doing silver as a practice for pretty much anyone that's starting out on this, just because it's not going to move much at all. And the premiums aren't a ton either, but it's not going to usually have very dramatic movements. 29.93, about 30. You could sell the 29, make $40 off it, 45 or so. And if you want to be safer, sell the 28, make about $20. Selling the 28, $20 off 405. 28 over 405 is pretty good. 7% on your money off the margin. Okay. One thing I want to mention on margin, if you're doing only a margin account, I would use only up to around 50% of your buying power. You don't want to use like 90% of it or almost 100. So it's because if you got to sign on anything, you need more buying power because you own shares. Okay. So those numbers are a little bit skewed. Like, sure, I could make 7% off my margin, but I'm only using up to half of it. So pretty much cut this in half. You're looking at maybe 3.5% on on your total account, which is still perfectly fine for me. Okay. That's really all I have ready for you guys prepared. So could leave it open for any other general questions on anything you have. Could be coverage triangles, technical analysis, whatever you have. Floor is open. Oh, open office hours, as the professor says.
Thank you, Lance.
No problem, Ron. Any other questions?
So Lance,
I'm
can you,
good.
Okay. Mark, you have one?
yeah, I was gonna say, is there a way you can just do like a real quick technical analysis on one of these stocks, like to see how you're, reading the chart in terms of you know, the uptrend or the downtrend?
Or do you want to pick one at random out of any of these?
Anyone is fine. Anyone should be fine. I mean, obviously,
All right, I'll do KMI. It's Kinder Morgan, relatively low volatility. They're a energy company. I think they do storage of energy. All right, so daily chart. Let me look at the numbers here. So on the daily chart, we went from November was a recent low of around 24 and change. It ran up pretty hard up to 31, and then it's starting to consolidate, and it's within around 26 to around 28 or so.
mhm.
So I'm just looking at the candles and nothing else right now.
Are those your support and resistance lines there?
Yeah, this is
The green and the red.
yeah. Well, the green and red are just the candles. So a green candle means it went up in the end of the day. A red candle means it.
I'm talking about the red line at the top and the green line at the bottom. That's your support at the bottom and your resistance line at the top.
Oh, this is the recent low, and that's the recent high off a certain time frame. I could just take this off completely for now.
Okay.
General trend lines. I'm not sure if you ever knew how to do this, but you want to look for multiple touch points. So if I go in the lower one, we went here, and then it kind of broke up here. However, that's a decent lower trend line around there. For the upper trend line, we went from here. I gotta do it all. So it's the high here, down there. It doesn't really work well. So I'd go from where it dropped. So like here, you can see that there's multiple touch points on these candles. Here, around there, and here. I'm gonna go a little shorter time frame on the bottom one here. You can see there's a little uptrend right here. And then you see this little triangle forming, and we're pretty much right at where the triangle is. When you see a triangle like this, that usually means that there could be a movement pretty soon coming up. You could also look at like a TTM squeeze. I don't really use that too much, to be honest, but there's a chance of a pretty decent move coming up. Next, I would look at some EMAs. The green EMA is the 21-day exponential moving average.
Okay.
This yellow line is the 9-day exponential. Right now, in the daily time frame, we're right near the yellow. So we're right near the short-term EMA. The longer-term EMA, we're below it. It's not necessarily too bullish or bearish based on that. If you saw that the stock was above both of those green and yellow lines, that's usually a bullish indication. So if you're above EMAs, it's usually bullish. If you're below EMAs, it's usually bearish. Right now, it's not really showing either of those, to be honest. And I'm looking at the RSI. This is the purple line. If you're around 20 or lower, you're oversold, and there's a good chance it can recover and bounce back up. If you're around 80, like right here, we're overbought, and that probably means that it might drop down. Right now, we're at the 40s or so, so that's another showing that it's probably fairly neutral. There's a good chance that it won't really move much in either direction right now. And that's a really good stock to do for covered strangles because you're taking in premium on both sides. And there's a good chance you won't like get a sign on your put, for instance. Does that make sense?
Yeah, yeah, that was a good breakdown. Thank you.
I'll do one more. SOUN is one that I'm having a little trouble with. I
Are
know it's
those are those indicators there that I see, like sell call, sell put, are those proprietary to your brokerage platform that
this
you're
is,
using?
this is one that I helped develop. It's called the Theta Pro indicator. And it's
Okay.
one that I actually do alerts and stuff with.
Uh,
If you're interested, let me know and you could easily get it. But I do it for it just connects to Trading View. I do some trades there, and when I look at, I'm not sure. Some of you guys are in the daily credit spreads, so I just use this to find possible positions that I sold credit spreads on. So this one I did on Google today, and I sold a put, for instance. It's mostly an EMA, and so the EMAs are the green and yellow lines. The bonds or bands will help stop any like conflicting ones. Like if I'm at if it says sell put right now in SAUN, and we're below this blue Bollinger Band, excuse me, it won't flip the alert essentially. All right, so let me look at SAUN real quick because this one's having trouble. I sold a 16 put, I think. Yeah, I sold a 16 put, and I'm a little negative on it. It had a big drop, as you can see. Sorry, I'm losing my voice a little bit. We were trending between 12 to 17 or so. Some news came out and went negative. Excuse me. Based on this, it's still pretty bearish just because we're below the EMAs and we are consolidating around here. There's a good chance it stays around 10 or 11. Excuse me. My voice is done. Sorry, I'm gonna have to end this pretty soon. My voice is really losing it.
yeah,
Teaching
no worries. No worries.
teaching all day is hard for my voice. So
Well, thank you, Lance. Appreciate you.
yeah, no problem, guys.
Thank
You have a
you.
Um,
good night.
You too. Have a good night, everybody. Ask questions in the Discord as you have them, all right?
Take care. Thanks.
Yep.
All right. Have a good one.
Bye.